To further discuss the housing market in China, we are joined by Junheng Li. She's the author of Tiger Woman on Wall Street and a researcher at J.L. Warren Capital. Thank you for joining us tonight.
My pleasure.
I want to talk a little bit about home prices in China. In September, we saw new home prices in Beijing. They rose 16% as compared to the same month a year ago. They rose 17% in Shanghai and 20% in Shenzhen and Guangzhou. Are prices out of control? Put it in context for us.
I mean, I think, the high and the rising prices in itself is not indicative of any bubble. What we see in Tier 1 cities, which are the four mega metropolis, and the Tier 2 cities, most of them are capital cities, the demand is very high and likely to stay high. I think a government is working on the supply by building infrastructure, transportation, subways to connect the outskirts area to the center of the city. So in a way, that's effectively increased the supply of home stock. And that's working. And on the demand side, I mean, I think one of the reasons that the demand is so strong is because there's a limited viable investment vehicles in China. So we have stock market that has been non-performing for a very long period of time, and now you have wealth management product, which in my view is quite dangerous. And the stock market, the property market. One way to normalize the demand is to probably offer other viable investment vehicles, so the common Chinese people can invest in. So those are the short-term measures the government can engage in to cool down the property market.
Okay, so even though it is heated up, you don't think that China is in a real estate bubble right now? You're not one of those people who believe that?
I think China is so large. I mean, it doesn't make sense to include all markets as if it's one. Just like in the U.S., Detroit is very different from Southern California, and Southern California is very different from New York City.
So let's start with Tier 1 areas. You think it is a bubble? Or?
The irony is, I think, Tier 1 cities, we see high and rising prices, and I see the least sign of bubbles, versus in Tier 3 smaller cities, the price is low, and it's not rising. But there's oversupply because the real economy is not picking up. In those cities, I think there's signs of bubbles. So I think it's a mistake to paint a broad China market picture with one brush stroke.
Okay, and let's just say those smaller tier cities, if there is a bubble, if the bubble were to burst, I mean, would the impact be as dramatic as it was here in the United States when we had our housing crisis in 2008?
Oh, I think China is drastically different from U.S. I mean, in the U.S., you have the mortgage, say for example, mortgage in China is about 15 to 20% of GDP. In the U.S., it's about 85%. So in the U.S., going into 2008, it's a levered bubble. So in China, I don't think it's the households are not levered at all.
Because you have to have, what, 30% down to get a house? I mean, it's just...
And the mortgage payment is such that, in China it's 20 years versus in the U.S. it's 30 years. So levered versus non-levered, it decides the size of the bubble and how it's going to play out.
Now, the mortgages in China as well, aren't they variable rates? Not fixed rates. So isn't there a risk, though, that if interest rates do rise dramatically, that we could see a similar situation in China as we had in the U.S.?
I think, again, I think the mortgage is so low, and the way the mortgage is, the cash outflow is such that payment is concentrated towards the first few years of the payment. So, I mean, it's significantly different from in the U.S., which is spread out through the course of 30 years mortgage loans.
Okay, but we also saw the property stocks recently fell in Shanghai, and speculation that China will come up with some more regulation of the housing market to sort of cool down the market. Do you expect the government to implement any more changes in its policy to try to cool down the housing market?
I hope not. I mean, like I said, in the short term, the government can work on the demand side by offer more viable investment vehicles, and on the supply side by building the infrastructure. On the longer term, I think the government should focus on rebalancing the economy so that economy is dependent less on the investment and export, more on domestic consumptions.
And so what other kind of vehicles do you think that the government should allow Chinese investors to invest in so that they wouldn't be so heavily tilted towards housing? What can they do?
Bond market is significantly underdeveloped. So that's one area that they can offer products, and open up the rest of the international markets to Chinese people, so Chinese people can invest overseas, and that certainly will squeeze, put pressure on the demand to the domestic property market.
Thank you so much for joining us tonight. That was Junheng Li here at the NASDAQ.